Hi, I'm not sure this is on, but if you can hear me, I want to thank you all. I know this is such a busy time of year for everybody, and we just want to thank you for being here today. I think the press conference was great, but again, we think these issues are of such importance right now that we wanted to take some time to really have a community conversation about some of the challenges associated with payday lending, what's happening in Sacramento and DC on these issues, and how we can get the word out about PayDayPlus SF. And I'm really delighted to have such a great group of people on stage to help us get this conversation started. But then we really want to hear from you, what you all think about some of the work that you're doing. So I'm going to start it off just by asking a few questions to my colleagues up here. But first, I wanted to introduce them. Starting to my right, I have Paul Leonard. Paul is the California director of the Center for Responsible Lending. Their goal really is to end abusive financial practices. They're a nonprofit, nonpartisan policy institute, and I'd say are one of the premier research institutions in this space. Next to Paul, I have Luis Granados, who is the executive director of the Mission Economic Development Association. Luis and Meta have been really active in this space. They helped lead the charge to create the moratorium to say no more to new check cashers and payday lenders that was implemented here in San Francisco a few years ago. And next to Luis, I have my colleague Olivia Calderon, who is our California legislative director. And Olivia is really on the front lines of advancing a range of financial empowerment strategies in Sacramento that she's going to tell you some more about. And to my left, you all heard from Stephen Staff with with San Francisco Federal Credit Union, and of course the Treasurer Cisneros, who is next to them. And I'm not sure that the Treasurer mentioned that I feel really lucky that San Francisco is one of 2 cities in the nation that has an Office of Financial Empowerment. And so that's why a lot of these efforts come forward here in San Francisco. So Paul, I really want to start with you. I think we heard a lot at the press conference, but what else do we need to know about how these payday loans work so we're all on the same page? If I were to walk into one of these places on Mission Street, what happens?
I mean, I think that you couldn't have heard a more sort of a better articulated example than from Mark outside, who told the story of how you get a payday loan and what really the perils of payday loans are. The fact is that there are a lot of stores out there, and they're beckoning people to come in at all hours of the day and night. It's really easy to get in. It's much, much harder to get out. A payday lender's best customer is somebody just like Mark, who has living paycheck to paycheck, has a financial shortfall that comes up, and thinks that they'll be able to take out a loan, make it a one-time transaction, and then pay it off 2 weeks later and be done. The unfortunate reality is that there are way too many examples like Mark's of the people who the industry calls the 26ers. Those are the folks who take out a payday loan every 2 weeks during the course of a year, 26 times a year, paying $1,080 for one $255 loan without paying off any principal. It's easy to get. You need to have a bank account. So people who don't have a bank account, don't have a check account, are not getting payday loans, and they are making do in a variety of other ways. But let's be clear: if you're not banked, you're not using a payday lender, and you have to have a source of an income, usually a paycheck, which will get verified. They'll call your employer, and maximum you write a check to the payday lender, post-dated to your next payday for $300. You'll leave the store with $255 in cash, with the expectation that you'll come back at or by your next payday and pay back the full $300. If you can't, as Mark said, afford the full $300, you'll pay off that $300 loan, instantly borrow it right back for another $445, which is exactly the effect of simply renewing a loan, but it counts as a new transaction. And what happens is people keep paying $45 every 2 weeks, On average, California borrowers, households are taking out 10 loans per year, nearly one a month, and most frequently those are in back-to-back transactions.
And Paul, is this industry growing? And is there anything you want to say about who owns the payday lending establishments?
So, as was mentioned, there are more payday lenders than there are McDonald's here. There are 2,300. I think nationally and in California, the number of stores seems to have peaked a few years ago, has dropped a little bit, and in part the drop is because a few years ago the federal government and Congress enacted a 36% rate cap on loans to military members and their families, and so there used to be great concentrations of payday lenders right outside the gates of military bases all over the state. Because what better populace to be targeting than a young, financially illiterate population than our armed forces, representatives of our armed forces. The Department of Defense really had to urge Congress to crack down on this for their military members because they were having trouble sending their military members abroad and to fight in the two wars that we're fighting in because they had credit problems with payday lenders. So we've sort of peaked in terms of the growth. However, the number of transactions has been growing steadily at about 10% a year for the last 3 or 4 years here in California. Is the mic on?
Yeah. Great. Luis, I'm going to turn to you now. I remember you working really hard to get this moratorium on check casher and payday lending establishments passed in the city a few years ago. Give me the neighborhood perspective on these institutions. What do you hear from residents who are going to get these loans? Why are they going to get them? And what's your main concern about them here in the Mission?
Well, just to give you a little bit of context, in the neighborhood we have 46 of those entities, primarily between 16th and 24th Street. So it's 46 of those entities. So that means, what, about 5 or 6 per block on a corridor? I mean, that's a huge saturation. So I'm wondering, I think it is the Mission that has the highest concentration of check cashing and payday lenders anywhere in California. We also have 11 financial institutions that are represented in the neighborhood. And what the Jaime Drano from our staff actually pulled out this figure for us. And he wants to ask the question, with 11 financial institutions, which I think is very different than most low-income neighborhoods, why do we need 46 check cashing and payday lenders? And the reason is because the mainstream financial institutions are not providing the appropriate set of services. Honestly, I don't know why people use these institutions. I think it is part of the fact that there's lack of financial education. I think that people are intimidated. I think people are used to using them on a regular basis. And I think we need to be more proactive in figuring out how to reach out to those individuals. And it might not be by talking to them about financial services and asset development. That might not be something translate, but perhaps they may be more open to talking about financial education if we go the route of linking them through their childcare services, linking them through their tenancy services, linking them through their health services, linking them through the other benefits that they receive through the city. I think that this is one of the challenges that we have, is that financial services and asset development are in a vacuum and they're not accessible. And I think our challenge is to figure out how do we bring the services in the context of community development. They're not sitting out there on their own, they're part of our community development strategy.
Thank you very much. Steve, tell me, why create a new small dollar loan? Why not just cap or ban them as something that's been called for?
Great, thank you. I think as we saw, we really saw the need out there in our community, and we saw that the average payday loan was about $400, and so that's why we developed this program for $50 to $500. We really see people sometimes even use these, as a kind of as a bridge loan. Just recently, one of our experiences was a member took this loan out. They were just waiting for their paycheck, and then they were able to cover that. So we really saw that there was a need to help at the small end. Also working with the 6 different credit unions that are all of different size, so we wanted to have a program that we could apply uniformly to all 6 credit unions that they could make available and to work with the various sizes of those particular credit unions.
Great. And tell me, what exactly does someone need who comes in? Like if someone here wants to refer someone, go themselves, or tell their friends and coworkers about this.
Okay, great. Part of the qualifying criteria is the same as based on San Francisco. So you need a valid identification because we do need to identify the individual. And let me say, sometimes where we see these loans are to members that are already existing to the credit union, and sometimes it's people that are brand new. So kind of speaking from someone who's brand new, would be a piece of identification, either their driver's license or a city ID, as well as a proof of residency. Credit unions, we have to qualify them for membership. Most of the credit unions here are open to community charter here in San Francisco, so that means anybody who lives or works or worships in San Francisco can join the credit union. So we just need to prove that criteria. And then they need to prove their income eligibility, where their employer is, and how much they're getting paid so that we can qualify them for that loan, as well as government assistance could also qualify as an income source.
And Steve, what do you need from people here in the room to really spread the word about PayDayPlus SF?
I think this forum has been excellent and the coverage that we've received today, but we've really seen it through word of mouth, working with our various community groups. We've really seen that the message has gotten out to those individuals and really those that need a source for either bridging their income or that have an emergency transaction. And the word is really starting to spread, and I will say we've really seen a pickup in volume in the number of accounts that we've seen open through this process.
That's great. Thank you so much. Treasurer, I've heard payday lenders often describe themselves as service providers, that they are the lenders of last resort. They are the only ones who have not left low-income communities, and that what they do is just like a social service, that they are what often stand between people and the streets. And I just wanted to hear how you would respond to that.
Thanks, Ann. I think if you talk to the providers of paid lending loans, they will say a lot of those very same things. They will tell you that they have a loyal customer base. They will tell you that they are well integrated in the community, to Luis's point. They will tell you that they are doing a good deed and providing a good service. I will not argue that helping people in need is not a good thing to do, but there's different ways to do it. And there's a way you do it where you help them in a way that's going to be beneficial for them immediately as well as in the long run. But these folks have found a way to help people, to quote-unquote help people, in a way that's actually harmful. And it really comes down to, as you've heard over and over again, the characteristics of the cost of a loan, the nature of a loan, the rollovers, and the fact that you basically end up paying back more interest than you actually borrowed in principal in the first place. And this is not a healthy way for any of us to do business. And so when it comes to the way that we characterize these loans, I think we have to be careful. I think we have to be sure that we don't make people feel bad for looking for products and services when they need them. We're all going to need help at one time or another. We're all going to need some support. We all might need a loan of money at one time or another for one reason or another. But we all have choices of where we go to get that loan. What I'm excited about PayDayPlus San Francisco program is it brings some more choices to some of the neediest people in our community, gives them a chance to look somewhere else other than these predatory payday lenders.
Thank you. Paul, I'm going to go back to you. Tell us, it sounds like the city is really doing what it can, kind of with the tools that it has available to create new alternatives, prevent new payday lenders from opening. What's happening in Sacramento on this issue? And tell me about the dynamics of when kind of legislation to address payday lending has moved forward in Sacramento.
Well, We have been working with a coalition including a number of my colleagues, Norma Garcia from the Consumers Union, Liana Molina from California Reinvestment Coalition, to try and address the issues around payday lending in Sacramento. And quite honestly, the fight is a huge uphill fight. A couple of years back, we had a proposal to limit interest rates to 36% annual percentage rate. That bill didn't make it out of its first committee. We decided, we learned our lesson, and we were going to regroup last year, sit on the sidelines, and the payday lending industry basically worked with a Democratic member from Los Angeles to introduce a bill that would, in the name of providing some additional protections, actually expand payday lending by increasing the maximum loan amount from $300 to $500. I think that there are sort of two overwhelming facts about what happens in Sacramento. Number one, it's enormously parochial and insular. And so largely the members only hear from the interests of the payday lenders. And the payday lenders have an exhaustive team of lobbyists who are up there who are working with members of the Assembly and the Senate on a whole range of different kinds of issues. And as a result, they're very effective. Secondly, as you laid out, I think the widespread perspective is that everybody is worried about having a place for borrowers to go when they're in trouble. And there is sort of a sense that you can't establish a meaningful set of consumer protections without putting the payday lenders out of business. And so I think there are many well-meaning legislators who believe that reforms that are essential to protect consumers to offer fair and responsible products will put the payday lenders out of business and borrowers won't have any place to go. And so I think it's really important that this initiative get as much attention as possible, both in terms of the community knowing about it, but also in terms of policymakers knowing about it, and the other credit unions around the state, who the Golden One and Schools First. There are a bunch of other credit unions in addition to the ones here in San Francisco that have begun to realize this. And so the idea that there are some alternative products out there is a critical piece of educating members in Sacramento about the possibility of having alternative products.
Thanks, Paul. And what about the federal level? Is there anything in addition to what we heard from Jackie Speier? Is there anything active right now that would address these issues?
At the federal level, there have been, Senator Richard Durbin has introduced a 36% rate cap, which Jackie Speier and I believe Maxine Waters have also introduced in the House. There seems to be no imminent action on that. There was some discussion about introducing some amendments to the Consumer Financial Protection Act last week in the House that did not get ruled in order. So I don't know that there's any immediate action likely to occur specifically around payday, additional regulations on payday lending in the immediate future. As Ms. Speier mentioned, there's also the bill that she will be introducing that Senator Cole introduced to create a new loan loss reserve for community development financial institutions to help innovate and scale up the CFIs who are involved in these kinds of lending.
Thank you. Olivia, tell us give us the story from Sacramento. What financial empowerment strategies are moving forward right now that you want everyone to know about?
Thanks, Anne. If I could just go back to the payday lending fight in Sacramento, I'm really excited about this product because of the potential that it could have again to keep the ball moving forward and momentum to regulate payday loans. One of the things that in conversations with staff and with members before hearings or afterwards, when members of the Latino caucus or the Black caucus will say, if there were alternatives out there, then I could wholeheartedly vote to regulate. But without an alternative, my constituents need this product. We have emergencies. And why? Because folks are just not saving. They are living paycheck to paycheck. You have a medical emergency or your car breaks down and you need to fix it. And as was mentioned in the press conference, folks go out there and are getting these payday loans because they need them. And it's so exciting that there's going to be now this responsible product out there for us to go to members and say there are alternatives, but if you don't regulate and you don't cap these payday loans, then these great products are not going to scale up, because payday lenders are all over the community and have proliferated, and it's impossible to really compete. Like one of the reporters asked at the press conference, right? I mean, they're everywhere, so what are we going to do? And so I think this is really exciting to be able to go back and say, look, now there are alternatives, so do something. Because you said that if there was alternatives, then you would vote to regulate payday loans. So the time is now. But there are other proposals that are moving forward. Again, we know that here in California, we have a really high asset poverty rate. The 25% of households don't have enough savings if they were to lose their job tomorrow to get the poverty level for 3 months. And 15% of households, well, they don't have any savings at all or any net worth, and if they lost their job, they'd be out on the streets or, you know, in line to get welfare somewhere. And so it's so important for us to make it easier for families to save. And so one of the things that we've been doing in Sacramento is trying to eliminate the asset test in the CalWorks program, which is the welfare to work program. It was created to help people get back on their feet again and self-sufficient. I mean, it's welfare to work. And there are these asset tests. You can't have more than $2,000 in savings to be eligible for it or to stay on it. And your car can't be worth more than $4,650. And, you know, I heard in the testimony, this woman said, from AARP, she said, you know, the car is the two in welfare to work. And families need to have a car to get to work. And families should be saving when they're on CalWorks, right? You shouldn't be penalized and spent down. And you, Anne, say this, and I love when I hear it. You say, you know, folks save their way out of poverty. You don't spend your way out of poverty. That just makes no sense. It's so counterproductive and just ludicrous. But what's more compelling right now in Sacramento is the fact that we've collected research. LA County has been an incredible partner that shows that California is spending $9 million a year to apply this asset test to everyone that comes through the door. They have to go through your finances and go through Kelly Blue to figure out how much your car's worth, to basically keep out less than 0.1% of folks. In October alone, for example, in LA County, there were close to 13,000 people that applied for CalWorks. Out of those 13,000 people, approximately 7,000 were denied. How many of those folks do you think were denied because of the asset test? Throw out a number.
All of them.
8. 8 people. It makes no sense. And so we're trying to reform the asset test in CalWorks, and I'm really hopeful because I believe that at a time where California, we're going into a $20 billion deficit, and the governor's always talking about waste and abuse. This is waste and abuse of working families throughout the state of California, and so I'm hopeful that 2010 will be a year where we can reform the asset test. Same time, we're trying to create more tools to bank the unbanked and help credit unions and banks out there that want to be partners with the community open up underserved communities. And so LA City just launched the Banking Development District program that's tailored after a program in New York that's been there since 2002. Basically, banks and credit unions would be eligible for state deposits if they want to open up in a community where there are no financial institutions and want to be real partners. But more importantly, in LA, they want to start developing products and services that are tailored to the needs of the community. Because you can have banks in poor neighborhoods, but if they're not meeting the needs of the community, then it's not going to make a difference. And so we want to take this and replicate it statewide and help credit unions again and community banks that want to open up in poor communities do so and start developing products that are meeting the needs. There's a lot of great stuff happening. Around the EITC, it's on everybody's mind. Everybody's buzzing about the earned income tax credit, and we're working with the administration to raise awareness and try to deal with the take-up rate so that more families are applying for the EITC. It's over, the average is over close to $4,000. We want people to apply for that money and more importantly, save some of it to make it easier for folks to save it. So there's a lot more issues moving in Sacramento, and I'd love to answer any questions or follow up.
Thanks so much, Olivia. That's great information I'm sure a lot of people didn't know about. I think we're going to open it up for questions, but I see a few people I specifically want to call out first, including Ms. Krakow, who is with the Community Foundation Silicon Valley. I think it's really interesting that the largest community foundation in our state was so concerned about this issue that they authored a report on payday lending in California, and they've actually developed a line of grant making specifically to focus on some of the challenges. So Pat, I wanted to hear from you. What did you find that was eye-opening in this report? And what are some of the strategies that are now moving forward in Silicon Valley to address this challenge?
Thanks, Anne. So here's the report. Yes, I don't know if I do. So the report is the report on the status of payday lending in California. And we commissioned this report. The Law Foundation of Silicon Valley, Leslie Cook next to me, coincidentally, is one of the principal authors. And there were a lot of eye-opening things in this report. Some of the statistics that we heard from Paul Leonard in terms of, and that you have said about the $800 cost of a $300 loan, the number of payday loans that go out to people in the debt trap that people fall into. I think in terms of the most surprising was really the lack of reform, movement on reform in terms of California, that there has been so little movement in a positive direction. So that was very eye-opening. And then locally, there's actually a section that talks about maps that have been developed by the California Budget Project that maps the clustering of payday lending establishments in different districts, assembly districts, and it shows in a very visual way. For example, in Santa Clara County, in an affluent community, Ruskin's in Palo Alto, there are only 4 payday lending establishments versus in Jim Bell's district where there are 25, as in parts of San Jose, Campbell, etc. So the clustering of these in communities of color and low-income communities versus in more affluent areas. So sort of the more vulnerable folks are having these establishments in their backyard. So the study makes 3 recommendations that we have acted on. The need for policy change at the state and the local level, the 36% interest rate cap, the state level, and the importance of local ordinances like what San Francisco has. A second recommendation regarding the need for alternative small-dollar loan products, such as what we're talking about today with the credit unions, and the need to expand public education about harmful effects. So what we have done is to make grants to 3 institutions. One is for a coalition of 5 organizations working in San Jose, actually to mount a campaign with public education, outreach, advocacy around a local ordinance in San Jose. Another grant focused on San Mateo County to do similar work, but at a more nascent stage to understand sort of what the levers for change, what the problems are, and who the folks to work with. And then a third grant to actually shape the messaging around lending focus groups and a survey to counter, sort of understand the motivations of payday loan borrowers, and then be able to understand public opinions and counter some of the arguments that will be coming up in these policy advocacy activities.
Great, thank you so much. And Liana is right behind you from the California Investment Committee. They actually have a campaign focused on payday lending, and I wondered if you wanted to say a few words about that. Can people hear the people in the audience? Do we need to be passing around a microphone? Oh, for the video, I think it's our preference, if you don't mind, if you use the mic. So, thanks.
Thanks so much, and I just want to commend the leadership of the City of San Francisco and 6 credit unions and the Treasurer's Office for taking this very important step to help us effect statewide policy change. This issue of lack of alternatives really is probably one of the hardest challenges in getting our state policymakers to enact real consumer protections. So this is a great model and one that I hope we can lift up, and absolutely encourage you all to talk to your colleagues and your counterparts across the state to innovate similar models. I'm with the California Investment Coalition. We're based here also in San Francisco. We do work statewide, and we've been working on this issue for the last several years. And our approach has really been to work with partners like the Community Foundation, like the Public Interest Law Firm in San Jose, around building a comprehensive campaign, really reaching out to various stakeholders, community groups, service providers, and the like, labor unions, to talk to city councils on the local level, but really to build momentum across the state and to put some pressure on the state legislature to pass a rate cap. There's a tremendous lack of political will currently, and also industry, very, very strong industry opposition to any kind of reforms that would make a difference to consumers. So, the example that Paul gave around Assembly Bill 377 is a huge fight we're having on the Capitol now. And so I would like to ask Treasurer Cisneros to consider, whatever you can do in San Francisco to perhaps pass a resolution or talk to other, influential folks across the state. That would be very helpful. These land use ordinances are the key tool I think that city councils have to address this issue as they're preempted by state law. But our hope is that over time we can get major California cities like San Jose, the largest city in the Bay Area. Los Angeles is very important. We're working with a coalition down in San Diego and actually had some success in Sacramento in enacting similar, here in San Francisco, I guess it's moratorium, but other cities use zoning laws and guidelines to make sure that areas that have high concentrations are not allowed, or that payday lenders and check cashers aren't allowed there. So that's one of the key kind of components of our campaign, and really looking at that as a tool to build a base of activists and advocates across the state who are calling on policymakers to really do something about this. So again, thank you all for your leadership.
Thank you. I think we have a question up front here.
By way of example, if PayDayPlus issues me $300 on a 30-day loan, how much do I pay back in that month? Approximately.
Well, I guess you gave me an example of a $300 loan in a 1 month. You would approximately pay $318 approximately, but we have terms that are up to 12 months. So again, it's really to give a schedule of payment that's affordable for somebody to pay that back.
It was a great performance today. We've got to get to another meeting. All of us. Thank you.
We have a pretty good idea of how payday lenders work. Can you tell us step by step what somebody would encounter going into a credit union
Sure. And one of the first differences with the credit union is as an individual comes in, we really try to assess what their needs are. Actually, kind of in the last couple of months, as we've had members come in and ask about this product, we've actually found that they have another line of credit with us that we're able to make a loan at a much lower rate than even this particular loan. So it's really, first of all, addressing the needs of the particular individual. But again, the criteria is to first make sure they're eligible to be members of the credit union, their identification and residency, and then second is their income and looking at their income that they're receiving, and then setting the amount of the loan from $50 to $500 depending on what the individual needs, and then a term of up to 12 months to pay the loan back. The other thing that we really do offer them is financial education. How can they learn more about their financial situation? Many of the credit unions here, we've partnered with an organization called Balance, and that's really to help them. There's online information that they can look at, or they can phone, or they can actually meet in person and learn more about their financial literacy. So those are really kind of the differences there.
I guess what I'd like to add to that is, I think what you're hearing is that a lot of the initial criteria and the actual decision criteria for having a loan, receiving a loan or not receiving a loan are very similar between this product and the payday lenders. But what I'd like to stress are the options that are available at the credit union that are not going to be available at the payday lenders. And that's to have a real relationship with a fully functioning mainstream financial institution. Folks that will be there to talk to you about what all our needs might be down the road. And the day we walk in, a week later, a year later, or even further out. And that is really the opportunity that we're excited about here, is getting people into those relationships. Because when they have only a relationship with a payday lender, they have one service that they're offering. That is, come back and get another loan from us, or we'll roll to the same loan, or whatever the case may be. There's no opportunity to save. There's no opportunity to plan. There's no opportunity to get financial education or budget, or to actually get a car loan, a student loan, all the things that probably many of us are going to need at some point somewhere down the road. And that is really what we all get access to by having a relationship with a mainstream financial institution. And my favorite amongst those are credit unions.
I think in the context of this conversation, I think we often, for Meta, we think about homeownership, we think about starting businesses. I think right now we're talking about creating a new financial product and opening bank accounts. But I think part of the problem with our work is that we skip over the financial education and we don't make it explicit and we don't connect that to the actual services or products. And I think we really need to do that. Figure out how financial education, talking about debt, savings, and credit is explicitly connected to each of these services and products. And I think as a sector, we haven't quite done that yet. And I think paying more attention to that, I think is going to be very important. I just want to thank José Cisneros and his office, Lee, Marco, and David, for the work that you guys have done with Bank of San Francisco and this product. And I also want to encourage you guys have done such a great job. But I think the thing to think about when we think about other things that we could do, and going back to check cashing and payday lenders, is about thinking about how do we increase the business fee for check cashers and payday lenders. They have to review that business fee on a yearly basis. Could that be enough to support some of this financial education programs? Could we excise local tax on them? Could we think about how to create revenue from them to actually pay for the harm that they're actually doing? So if you would consider that, I know you talked about it, Jose, so maybe over the next couple of years we'll see something coming from your office around that.
Great idea.
Financial literacy, the controller, partnering with him again in 2010, he wants to start an Office of Financial Empowerment, and he wants to be housed in the Office of the Controller. John Chang has really been a champion of this issue and understands that consumers need access to information, and they need access to all the options. And so I would also encourage you to partner with John Chang, because I think this is kind of things that, the Office of Financial Empowerment would get out to the community, but they want to be a clearinghouse to get all this information out and available to Californians.
Great. I think we're going to take a few more questions before we wrap this up, and I know a lot of us will stay here informally and continue the conversation. We just want to be respectful of folks' time. So there's a gentleman in the back.
Thank you. Hi, I run a small nonprofit. We issue zero-interest loans to people through some credit unions in this room here. And one of the challenges that we face is getting people through the door of the credit union. And one way we try to do that is we work with nonprofits who have relationships, basically building on what the Secretary Cisneros said. It's about relationships. And a lot of those nonprofits have relationships with those clients. If you can market your program through them, these people come to nonprofits in distress. They can help bring them to the door and either walk them through the door and cross that threshold, get people into the system. Payday loans are just so easy, and they're anonymous. So that's, I think, it's part of the issue. But if you can have somebody bring them to the door, I think that would help.
Thank you for that.
Hi, my name is Maria, and I represent the Family Initiative Independent. A question I have is, so this PayDayPlus is also for non-immigrants who have ID numbers? Because we have thousands of families who are in the program, but they don't have a social security number, but they do have an ITIN number, and they have the city ID.
Yeah, so the answer to that is that if they have a taxpayer identification number, then that is an opportunity for them to come in and we can talk with them, and they're eligible, and also residency here in San Francisco.
And to the lady in the black, who said that take advantage of the earned income credit, I would love to take that advantage, but we can't. I have a family of mine who, my husband is an immigrant, and because he doesn't have a social security number, we can't get that. So I think we should fight for that.
Hi, my name is Otis Ford. I'm with Alameda County Associated Community Action Program.
And what I would like to see as part of your collaboration is some of your educators sitting on this panel. The largest group of individuals filing bankruptcy is between the age of 18 and 24. So once a person reaches the age of 18, they're sitting back for these predatory lenders. So we got to stop the domino effect and cut them off right at the beginning. So let's get some of our educators up here so that we can get financial literacy in some of our schools. So that once they reach the age of 18, they'll be educated and they won't get caught up in the system.
I want to thank you for that very comment. In our Office of Financial Empowerment, we're actually in the process of putting together a financial education network, a comprehensive view of all financial education offerings right here in San Francisco. We're hoping to launch that early into next year. And as a component of that, we're going to be looking at what kind of youth training we can see rolling out there, either through community groups like Boys and Girls Clubs and things like that, or school systems, all of the above. I'm not going to pretend that we're going to have everything covered day one, but at least we're going to start to get a comprehensive view of what's out there, and then we can start filling in the gaps.
Thank you.
And can I add, as a coalition of credit unions, we're actually working with the local schools here in San Francisco, getting into the high schools, teaching financial literacy. We're actually seeing that taken home, shared with their parents, and we feel that that's very important to actually start it at that level. We would actually like to see at the statewide level that become an initiative. So we're really trying to partner at that level also.
And I don't want to forget to mention that the Mission SF Federal Credit Union has a youth credit union that they host every year, which is entirely staff, man, and marketing to youths in the mission. And I appreciate all the great work they do.
Okay, I think we are going to conclude this. I really want to thank everyone for being here, and I'm really excited that we've already gotten inquiries about PayDayPlus SF from Los Angeles, about doing this down there, from Butte County, from San Jose, and so I think this is a first step. The work's not done. We need better products. We need better policies. And as someone who's worked for politicians before, this is a good issue for politicians. You look at the polling on support for capping rates on these 400% loans, and the support for it is like 70%, 75%, and there seems to be a lack of energy in Sacramento around this issue. Well, with all budget cuts and the services that are being cut for people, this is a way that policymakers can really do something meaningful for families that isn't going to have a direct impact, on the state budget, frankly. So it's going to take, the energy of a lot of us here in the room and a lot of others throughout California to move things forward. So I know we all look forward to working with you. We're happy to continue this conversation informally. And again, I know how busy everyone is this time of year. So thank you so much. And I really want to thank all of my colleagues.